Hey guys, welcome back to the channel. This is Fredpasselli.cpa based out of South Florida, owner of Passelli Accounting Services. So today what I want to talk about are the other basic financial statements that we did not go over in our first video. In the first video, what we went over was the income statement and the balance sheet. Those are the two main financial statements that I really want you to learn, especially when you're starting your accounting career. So remember, the income statement is revenue minus expenses. You're going to equal net income. Then you later will learn the multi-step income statement. Essentially, all that's doing is breaking out income and expenses by subgroups. Then we have the balance sheet. That is assets equal liabilities plus owner's equity. That's essentially the accounting equation in itself. And basically, that's where a company is going to list out everything it owns, its cash, its property, anything you can think of that would qualify as an asset. And then the other side of that on the balance sheet is how did they acquire those assets? Were those assets acquired with equity that they put into the company? Or was it acquired with debt or bondholders' money? So that would be the liability section, and their own equity would be the owner's equity section. So just a quick little recap there of what we went over last time, the income statement and the balance sheet. Now, what I want to talk about a little bit today is going to be the other two financial statements that make up the big four financial statements that you need to learn. So the other two are what we call the statement of cash flows and then the statement of retained earnings. So I'm going to touch first on the statement of retained earnings. This one is probably the smallest of the three. It's probably the one you will also use the least in your beginning accounting classes. Once you get into your more advanced accounting classes, you're going to see it a bit more. But essentially what the statement of retained earnings is, it's showing the change of retained earnings at a company and what drove that. So in most cases, remember what a retained earnings, all it really is the accumulation of net income and basically what caused that, whether it was a loss or a profit for the year. So statement of retained earnings, normally the way it's set up is you're going to have beginning balance, so let's call that $500, and then you're going to have additions to retained earnings, which is normally net income or some form of profit, and then you're going to have subtractions of retained earnings, which for simplistic purposes are normally going to be losses or things of that nature. And then you're just going to have ending retained earnings balance. So it's also another thing that you're going to see on the statement of retained earnings that's going to be a negative is going to be dividends paid out. So remember, dividends are basically payments, whether it's cash or some sort of property or stock payment, basically to owners of the company. That is going to be paid out of retained earnings. Because remember, a company cannot pay out a profit, cannot pay out a dividend unless it actually has a profit. And where is that profit accumulated? Where does it grow? In the retained earnings account. So remember, retained earnings, you're going to start with beginning balance, then you're going to have additions to it, which is normally a net income or some sort of profit. Then you're going to have subtractions of it, which is if you had a net loss or you paid out dividends. Then you will get your ending balance, and that will be the statement of retained earnings. It's normally not going to be too complex once you first start learning, but statement of retained earnings is important to know. It basically explains to your investors and other interested parties where those, basically the retained earnings account, where the activities go, what the activity is, and what's driving it. Now, the second financial statement we're going to talk about today, just a little brief overview, is the statement of cash flows. This is one that's very important to learn and understand what it actually represents later on in your accounting career, because it is showing exactly how the company is making money, whether it's from operations, investing, or financing. So when I say making money, where are they getting their cash from? Are they profitable? Or are they just getting cash from issuing debt, issuing bonds, or just issuing more equity? So you ask, why is that important? So, a lot of people are going to look essentially at a cash balance when they're analyzing a balance sheet. They're going to say, oh, this company, they have $100 million of cash. But what's really important is, where is that cash coming from? Is that cash Was it derived from good business? Was it derived from operations? So that's a good segue into our next part of this. So the statement of cash flows has essentially three parts. It has cash flow from operations, cash flow from investing, and cash flow from financing. So the first part, cash flow from operations, what that essentially is you're going to look at is the business making a profit and how much cash are they getting from that profit when everything is said and done. So if they have a net income and that's a good profitability collection on cash, that's going to add to their cash flow from operations. If they have a net loss every single year, that's going to decrease their cash flow from operations. Then you have cash flow from investing. So cash flow from investing would be examples. The best way I can think of that is maybe a company is buying and selling land, buying and selling equity as in stocks of other entities. That's key to differentiate between cash flow from investing, cash flow from financing. So, and it could also be other, financial instruments where they can make a profit from gain or loss. So, cash flow from investing, think about buying and selling equities, stocks, land, property of other entities. Cash flow from financing is essentially going to be if your company itself is issuing more debt. Maybe they're issuing bonds, maybe they're issuing coupons, maybe they're issuing more stock. So, why that's important to know where their cash is coming from is if they have $100 million of cash on the balance sheet, that looks good. But if 95 million of it is all from cash flow from financing due to issuing more debt, then they also have a corresponding 95 million debt associated with that $100 million of cash. So what's their actual net cash? In this case, it would be 5 million. So it's important to see where their cash is coming from. Then also look at another example is maybe that 100 million of cash, maybe it came from stock they just recently issued. So what you're seeing there is they're giving away more ownership in their company just to raise cash. So those are all red flags you can also look at when you're evaluating a company or just going through your accounting classes. Try and basically see what you would do here is you would get the balance sheet, you would get the income statement, and you get the statement of cash flows. So the first thing is, go look at the balance sheet, see what the cash balance is. Then once you get that, go look at the income statement, see did they make a profit or did they have a loss. Then go to the statement of cash flows, see if it was from operations, investing, or financing. If a company has a net loss every year and the only way they're paying their bills is by issuing more debt and more stock, it's probably not a good long-term company unless they are a startup or a new entity that's, having some issues in the beginning. So, it depends on the type of company you're looking at. But just to take a step back, the main things you want to know for statement of cash flow, there's three parts. Statement of cash flow from operations, cash flow from financing, and cash flow from investing. You have to learn what those three are. So remember, operations, think of net income, net loss. Investing, thinking buying and selling of equity, stock, land, property, cash flow from that. And then financing, think about basically issuing debt, issuing stock, issuing some form of instrument to raise capital. So try and understand where the company that you're looking at is getting its cash from. That's why the statement of cash flows is very, very key. Now, it's important to, in your accounting career, learn all four of these financial statements and see how they flow together, right? So that you have the income statement. That's where either net income or net loss is going to be shown. But what's important to know is the net income at year end essentially flows to the balance sheet, and that is where the accumulated net income or net losses are going to be basically booked throughout the year. I will do another video in the future basically explaining how all the different financial statements tie together, but what's important is once you learn that, everything will begin to click with accounting. Now, my main thing is I would recommend to look at, maybe companies that you like, companies that you invest in, or companies that you use a lot. Go onto a website like sec.edgar and look up their financials and, go to their net income statement, look at their net income, check their cash balance, and then try and look for the statement of cash flows and see if you could figure out what's going on there. So just to recap, statement of retained earnings, it's important to know. It's basically just showing what caused the change of the retained earnings balance. Remember, retained earnings balance is the accumulation of net income or net loss minus paying out dividends. And then statement of cash flows, essentially what that's showing is where is the entity getting its cash from? Is it getting it from having a profitable business with good operations? Is it getting from investing in other companies or assets and making a profit from that? Or is it getting from issuing debt and equity? So I'm glad you guys tuned in today. If you have any questions, please look at the contact information below. You could always reach out to me via email or also phone call. Have a good one.